This one candle just cost me $1,000 in about 5 minutes. And if you're using the popular pattern scalp strategy, it's probably cost you money too. Here's the thing though, it wasn't the strategy that was broken, it was how I was using it. Stay with me because I'm going to show you the fatal flaw that nobody talks about with this strategy. And more importantly, how to spot it before it wrecks your account. If you've been trading for any amount of time, you've probably seen videos about the pattern scalp or one candle reversal strategy. It's everywhere on Trading YouTube right now. And look, I get why it's popular. The concept is simple. Wait for that big aggressive opening candle, then trade the reversal when institutions are done manipulating retail traders. Easy money, right? Well, not always. I want to share with you the one thing that can turn this profitable strategy into an account killer and how to protect yourself from it. But first, let me quickly walk through how this strategy is supposed to work, just so we're all on the same page. The idea is pretty straightforward. You wait for that first 15 or 5-minute candle of the session to close. This becomes your manipulation candle. If it's big enough, we're talking at least 15% of the daily ATR, then institutions are supposedly sweeping liquidity. You box in that opening range, then drop down to a 5-minute chart and wait for your reversal signal. Could be a hammer after a red candle, what some people call a John Wick, or maybe a power tower setup. When you get that signal, you enter against the opening direction with a tight stop and target about a 2-to-1 risk-to-reward ratio. The theory is that once institutions get their liquidity, price will snap back in the other direction. Here's a brief explanation from one of the best traders online.
We are going to identify swing highs and swing lows in the market. And every single time price action creates a high, we are going to mark out those highs. We get a high, we mark out our high. If we get a new high here, we mark out the high. And we mark out the lows as well. That is the first thing that I want you to go ahead and do. Now, if for example, here we have that higher time frame external liquidity, we are going to be using the weekly time frame to mark out the external highs and lows. So the one candle that I want you to identify are the following. So here we have that weekly external liquidity. Here we see one weekly candle that closes above this external high. And this is the candle that I want you to identify. I want you to spot out a candle that either closes above the high or rejects the high. Here we can see, here we have a continuation candle. This is a candle that closes above an external liquidity pool. And here we have a rejection candle, and this is a candle that fails to close above a higher time frame external liquidity pool. So what is the significance of these two candles? We are either going to have one of two scenarios. We are either going to have a continuation candle, or we are going to have a rejection candle. So when we have a continuation candle, this is what I'm expecting the market to do. If the market is strong enough to close above an external liquidity pool, I'm expecting a continuation in the run. If the market isn't strong enough to close above external liquidity, and then I'll be treating it as a liquidity raid, and I'll be looking for a reversal. This is a run of liquidity. This is a liquidity raid. There's a difference between the two. If we have a run of liquidity and we have a candle that closes into a liquidity pool, the chances are very high that this market is going to dig in deeper into this higher time from external liquidity. But as soon as we get a tap and raid liquidity and the body closes below the low, I'm expecting a reversal to occur in this market. This is a lack of displacement, and this is a very clear displacement above an old high or old low. So why is that significant? This is significant because if we get a closure above the high, I'm expecting a continuation. So on a lower time frame, I'm expecting this market to draw into some sort of PD array like a fair value gap or a breaker or an order block to take a continuation trade because we have underlying momentum. If we get a rejection candle like this, what this means is this is most probably a market structure shift on a lower time frame. Now, here we can see the wick did the damage, but the body is telling the story. If we drop to a lower time frame, we are going to get a market structure shift in this leg of price. So that is why I will frame a trade to the downside, looking for a retest of a fair value gap or a breaker block or an order block to take and target the next points of interest. Now, that leaves you with a clue. As soon as we get a closure above an old high, where would my next draw of liquidity be? It is going to be the next swing high or low. So if we have a swing high here and a swing high, and the market closes above this, the next draw of liquidity will be this swing high. If we've tapped into it and we have closed above, the next draw of liquidity will be this swing high. So I'm going to be looking for a buy position until we hit this draw of liquidity. In the same way, if we fail to displace above an old high, where's my next draw going to be? It is going to be the next swing low. So if we fail to displace, my eyes drop down and I look for the next swing low to potentially use as a draw on liquidity.
And you know what? A lot of the time, it works. But here's where things get dangerous. The strategy has one massive assumption built into it that can absolutely destroy you if you're not careful. Are you ready for this? It assumes that every big opening candle is a manipulation that will reverse. But what happens when it's not manipulation? What happens when that aggressive opening candle is actually the beginning of a genuine, powerful momentum move? This is what happened to me last Tuesday. Tesla gapped up on news, and I saw that big green 15-minute candle. My brain immediately went,
manipulation candle. Time to short the reversal.
I got my inverted hammer signal. I entered short, and then the stock just kept running and running and running. The same thing happened on Tesla again. It gapped down this time. On news again. So the first 15-minute candle caught my attention. So here I am thinking,
just long this reversal.
And as you can see, it dumped hard. If I took this trade with the size I normally take, I would have lost $3,000 super quickly. See, here's the thing nobody talks about in those YouTube videos. When institutions actually want price to keep moving in that direction, maybe because of real news, real demand, or a genuine breakout, there isn't enough liquidity sitting around for a neat little reversal. You're literally betting against a freight train, and freight trains don't care about your John Wick hammer patterns. Now you might be thinking,
okay, so I'll just take the loss and move on.
But here are 3 reasons why this flaw is so dangerous. First, when real momentum is happening, your reversal signals can fail fast. That nice tight stop you planned, good luck with that when there's a gap down or the bid-ask spread blows out. Second, these momentum moves can last way longer than you expect. I've seen traders get stopped out, then watch the stock continue running for hours in the same direction. That psychological damage is real. And third, and this is a good one, the better you get at spotting manipulation candles, the more confident you become, which means you start sizing up your positions right when the strategy is about to fail you. So how do we fix this? How do you keep using a profitable strategy while avoiding this massive flaw? All right, here's how we solve this problem. I'm going to give you 5 specific things you can do to avoid getting caught in these momentum traps. Number 1, and this is huge, confirm with volume and context. If that opening candle comes with expanding volume that continues after the candle closes, treat it as momentum, not manipulation. Skip the reversal trade. Number 2, wait for higher confidence confirmation. Don't go all in on that first little hammer pattern. Let the confirmation candle actually close, or start with a partial position and scale in if it's working. Number 3, avoid news and time bombs. Don't trade reversals around scheduled news like earnings, Fed announcements, or major economic data. That's when prolonged moves are most likely to happen. Number 4, use real stop sizing with buffers. Expect slippage, especially on volatile opens. Don't place stops skin tight. Give yourself room to breathe and size down if the opening action looks unusually crazy. And number 5, this one's my personal favorite. Have a fail-safe rule. If price breaches a secondary level beyond your stop, like closing beyond the entire opening range by a certain percentage, cut the strategy off for that ticker for the rest of the day. The bottom line is this: the pattern scalp works because many opens really are engineered liquidity sweeps, but it fails when the open is actual momentum. Your job is to tell the difference. Let me show you what this looks like in practice. Here's a recent trade where I avoided the trap. This was Apple last Friday morning. Big red inverted hammer candle on the 15-minute definitely met our size requirements. Old me would have immediately started looking for the short reversal, but I noticed the volume here. It was expanding and continuing even after the candle closed. Plus, we had some news overnight that I should have been paying attention to. Instead of forcing the reversal trade, I waited, and look what happened. Apple continued spiking for the next 2 hours. That would have been a brutal reversal trade. Let me show you an example of how to execute a perfect reversal trade.
Hi traders, take a look at NVX. The stock is down more than 10%. Now, when the stock is gapping down that much, over 3%, you expect a gap and go, meaning a continuation. Meaning, if you expect it to come down, you can short it in order to make money from the fact that it's going to continue coming down. Now, that's the third minute, and as you can see, it's a nice technical formation. Try to move higher, took out the buyers. Now, I'm going to short 2,000 shares, and I'm shorting right now. Now, I'm expecting a breakdown under the lows. I did get the breakdown under the lows. I was expecting a big move under the lows. It came down, it reached my target, it touched 83.80. As you can see right here, right now, it's touching the lows, but really I just didn't get the chance to take my partial. It just happened too quickly. I was expecting a continuation. I was trying to get a little bit more, but I did not. So what went wrong? Well, so far nothing, because it hasn't touched my stop, but my stop is over the highs and I'm down, as you can see here, $2,000, and sadly it's moving higher, $3,000, about to touch $4,000 right now, and I'm moving out. I had my stop over the highs. It's not a hard stop. Never use a hard stop. That's a different lesson. We should talk about it in a different video. About to take my second trade. Take a look at what happened 18 minutes into the trading session. It tried to move higher and failed. Now, the first time, that's where it took me out. The second time, it failed. Now, when the stock is leaving a topping tail at a new high, it's one of the strongest ever reversal modes. Stock is moving to a new high, leaving a topping tail. Remember that it's one of the strongest reversals. I'm about to short 4,000 shares. Beautiful technical formation, and it's about to fail again, and I'm short now 4,000 shares. Now, the reason I'm short 4,000 instead of 2,000 is not because I'm trying to get a revenge trade. It's because it's 18 minutes into the trading session. Now it's proving to me that it wants to come down. At this point right now, that's the proof that it failed to move higher. Again, this topping tail at the highs, and the very high likelihood that this trade is going to succeed right now. Now again, just remember, there's two indications here. One, the stock is down more than 10%, therefore normally will gap and go. Second, it tried to move higher twice and it failed. First time when it took me out, it moved over the highs. Then it tried to come down again, tried to move higher, touched a new high, left a topping tail. That's a second indication. And then now it's consolidating, going sideways, and very, very likely to come down. So just came down under. I'm up 7 grand, 8 grand, and 9 grand, and I'm about to take my partial, about to cover 3,600 shares. Now left 400 shares for the continued run, and it did continue. Take a look at the way it moves even lower. I only have left 400 shares, and I'm looking for the point where it will be too extended to the downside, and we are getting there. And now I'm covering another 300 shares, leaving just 100, and it did continue. Now if you take a look at NVAX again, notice the stock now is down 14%. Please remember, a gap which is bigger than 3% is likely to take it even lower. So the first trade, right, that was just not the right timing. It didn't work out. Not that it did not touch my target price, but again, I had a loser. Does that mean I should not take a second trade? It doesn't mean so. The stock is likely to come down. So if you have a nice second technical formation, you can add more size. Not because, again, you're looking for a revenge trade, but because the fact that you have a nice technical formation. And again, I go back there and remind you of the way it tried to move higher and the topping tail. Again, remember, the strongest possible indication in technical analysis is when the stock is moving to a new high or a new low with a topping tail or a bottoming tail, and then changes direction. And once it proved to me it changes the direction and I have a nice technical formation, I can definitely at this point add more size. The reason for that, again, not a revenge trade, but the fact that it's proving to me that it wants to go my way.
Head to the link in the pinned comment to grab your free trial to TradingView. the platform profitable traders use to get the cleanest charts and best tools any trader would want. Look, I'm not trying to bash the pattern scalp strategy. When used correctly, it's genuinely profitable. I've made consistent money with it, but every strategy has flaws. And this one's flaw can be particularly expensive if you don't know how to spot it. The key is understanding that not every aggressive candle is manipulation. Sometimes it's just good old-fashioned momentum, and when it is, you want to be on the sidelines, not fighting it. Be sure to subscribe and watch this video next.